Hello and welcome. In this video I'm going to discuss to you why you should bother with spread betting, what it is, who does it, and how they do it. I'm also going to explain to you the principles of what they call going long and going short. Also discussing the timescales of trading, the day traders, also known as intraday traders, short-term trading and long-term trading, and what you would possibly trade in terms of a security for those time scales. So let's first of all start off with spread betting. What is spread betting? Well, in many respects the word betting is possibly the wrong word for it, because all the skills and methods and techniques that are used before you actually begin to spread bet are all based around trading. So really the assumption that's made with the term betting is that it's a gamble. And yes, in many respects trading is a gamble. There is no certainty as to what you're going to, or there's no certainty that you're going to profit as a trader with every trade that you make. So in a sense it is a gamble. But the word betting sort of serves up connotations of people putting a punt on a horse or doing various things that involve a matter of a greater degree of risk without there actually being any form of real analysis being undertaken. Whereas when we look to trade and trade spread bets as a profession, as a means of actually making money from it and taking an objective view on each trade that we make, it's more of a skill. We're actually using 99% of the skills a very highly skilled and successful trader would use. It's just the matter that spread betting is simply just the security in which we're using, the vehicle in which we're using to apply the techniques and obviously profit from. So do not make the assumption that spread betting is, say, the poorer cousin of futures trading or forex trading or anything like that. Spread betting over the last 10 to 15 years has come an awful long way, and it's been around for a good 20 plus years. One of the key things and one of the key benefits with spread betting, and the reason why it retains its name or retains the phrase betting, is because it is still classed as a bet, because basically all you're doing when you open a trade with your spread betting broker or spread betting bookmaker is you're opening a contrary position against them. So you're saying that you expect a trade to reach this value, or to go up in value, or to go down in value, and then you're taking a contrary view to what the broker is saying to you. By taking that contrary view, much like when you bet on a horse, the bookmaker is essentially claiming, based on its odds, that you're not going to win that bet. So that's how they work out their odds. So it's a very similar way, and because of the benefit that it is seen as a bet, and that it's seen by the UK government and many governments as a bet, most bets in most countries are classed as tax-free. So therefore any profits you make from spread betting are completely tax-free, and it's the only security. It's not really deemed truly as a security, but for the sake of argument we'll call it a security, for the sake of clarity really, because we trade it as we would any other security. It's the only real product or security that you trade that is totally tax-free. If you're trading futures or options, which spread betting is actually based on, that whole gearing approach, which we'll explain in a moment, is actually based on the futures and options. The other thing is with spread betting is that you can essentially bet on any price movement on virtually anything. The most common ones are obviously the indices, which we've covered and we can see in this chart here. But also we can trade on price movements on pretty much anything, be that on the forex, on the metal exchange sometimes. Also, a while ago you were able to trade or bet on house price movements, on interest rates and so on. But obviously you want to be able to trade using something that presents itself in terms of a chart. By using what we see in a chart, we're therefore able to plot that whole greed thing, which we were talking about in one of the other videos, where the actual price that we see in the chart is not based on any intrinsic true value. It's where it's based on that the herd, all the traders, all saying that it's valued around about that price, and that's based on what they think, what the demand is for that stock, what the greed or fear is being driven by for that stock, or in the case of FTSE 100, the culmination of 100 stocks, the top 100 stocks. So spread betting has an awful lot of advantages. One of the disadvantages with spread betting is that obviously if you make a loss, you can't then offset that against tax. Whereas if you were trading, say, E-minis or futures and options or forex or many of the other securities that are out there, any loss that you incur, you can actually, depending on which country you're on, you live in, but you can actually offset that against your tax as well. Certainly if you're treating it like a business. So how does spread betting work? What do those that are involved in spread betting do? Well, we've covered this in great detail in the modules as to the whole sort of theory and practice of how the calculations are made in terms of when you're making an up bet or going long, or a down bet going short. And I'll quickly just cover in using the FTSE 100, and we'll stick with the FTSE 100 for many of these videos because it's a degree of familiarity with many people. But when we say going long, basically what we're doing is that we expect a point or the current price to go up. Now, we won't cover it right now, but we use basically methods of analysis. By using the previous history of the chart, we can gauge trends. A trend is a degree of movement in a certain direction that's constantly going up or down. And this allows us to monitor, as well as other things that we look at, by the way, but this allows us to monitor as to where there may be points of potential growth, or where we're likely to see a slump, or where we're likely to see things fall down. Remember, the stocks never represent an intrinsic true value. It's always based on what people believe they should be valued at, and that value is derived from the greed or the desire or the demand for that stock, not based on the fact that say BP for instance, which is not perhaps the most popular choice at the moment, is actually producing more fuel or more oil. It's just the fact that the demand for oil has gone up, so therefore they expect BP obviously to constantly make more money. Also, if you look at companies like Tesco, it's they tend to swing up and down, and it's not because they're making more money or less money the previous day. It's just the simple matter of the desire for that stock, that greed for that stock. So, say for instance we're looking for the FTSE to go up, we would make a long trade. So we expect the stock or the trade to go upwards in value from its current point. So we would go online, we would say that we would want to buy the stock, because you buy to sell. So you would buy the stock, you'd buy, and then you enter the point value. Now a point is, in terms of a spread bet, is for the sake of argument, is 0.01p, 1 pence. So per point is 1 penny. So each penny that went up, you would then say, well, I bet £1 per point that it's going to go up from this current value. And then you do that online, and each time it goes up a certain amount, you would make £1 per point that it has gone up. And that's basically how it works. Each time it goes up a penny, you make £1, or whichever value you decide to trade at. Now, the reverse of which is also true, is if you suggested that the chart was actually going to, or the trade was going upwards in value, but didn't, in fact sank back down below the price that you said to the broker that you said it was going to rise from or go long from, and actually went in the opposite direction, then you would actually start to lose money to the same value per point that you were looking for it to rise. So that's where the risk is. That's where that gamble is. The actual point where you entered the trade, that is the sort of tipping point where, if it's going upwards and you said it was going to go upwards and you traded as a long trade, then you would make money providing it was above that point, that line. Say for instance, if we were looking to go upwards from here and it continued to go upwards, then we would make money. However, if it went below that, then we would actually start to lose money. Before you actually begin to trade, you actually place a deposit with a bookmaker, with the broker, with the spread betting company, and that allows them to use that as collateral against your trade. So you must have a deposit. Now that doesn't mean to say that it has to be thousands or many thousands of pounds. You can open spread betting accounts with just a few £100, and you can trade pennies as well. You don't have to trade pounds. So that's basically what going long is. Going short is the opposite of that, where we look to see, if we use the same example again, say we think that the chart, for instance the FTSE 100, is going to go down in value. We've analysed the chart, which we'll go into later, but say we've come to the assumption that it's going to go down in value. So we go short, which is basically we're saying that at the current value we reckon it's actually going to go down from that current point, and then we enter a trade. We say X amount, say £1 per point for each time that it drops a penny below the current value. So each time it drops, we make money. However, much like when we were looking to go long and it went below the starting point that we looked at to be going long from, in this case it's very similar. If it starts to rise beyond the point that we said it was going to fall, then we start to lose money. So there's two ways in which we can make money from spread betting, and basically the fundamentals are the same for any type of trading. You enter a point where you're saying it's going to pivot from. You say it's going to go upwards or go long, then you're expecting it to increase in value. If you're saying it's going short from the current point, you're expecting it to decrease in value and profit as a result. If the opposite to what you said happens, from that point that you entered the trade, you will then begin to lose money to the same value per point that you were looking to gain. So that is essentially the going long and the going short, or where the saying is, that's the long and the short of it. Now there are also different time scales on trading. There are those that day trade, or also known as intraday trading, where they're in and out of a trade within the same day. To intraday trade, you would need different information. Here we're actually just showing the end of day data, but if you are intraday trading, then you would need a different set of data, and that data is what's known as intraday data, where it's plotted either per minute, or per 5 seconds, or 10 seconds, or 30 seconds. It's up to you how that information is shown. Now, as a spread better, or as somebody looking to spread bet, you wouldn't necessarily want to trade intraday. The reason being is that I'll go into that later, but essentially the reason being is that there's a spread price for each time you enter and exit a trade. That's where the brokers make their money, and with spread bets they tend to be a little bit higher than they would be, say, if you were trading futures or options or anything, or e-minis or things like that, which are more designed for getting in and out very, very quickly. So I wouldn't recommend spread betting as an intraday trade. The best form of intraday trading using similar, basically the same charts almost, would be something like e-mini futures. So essentially a day trader or intraday trader is looking to get in and out of a trade very, very quickly, usually within 20 minutes, sometimes much less than that. You get people that are what are called scalping, where they literally just taking points here and there, just trying to what's they call scalp the market, where they're just trying to squeeze whatever they can out of the movements, which is a very risky way of trading. But most intraday traders will, usually if they're on a good day, will make several trades during that day. And it is, if you have the collateral to do it and you're trading the right instrument, the right security to do that with, can be very profitable. But it does require an awful lot of skill and an awful lot of nerve. Now from there, what most traders that are spread betting trade are what you call short term, where it's just, say a minimum of a couple of days, a few days, to maybe just a few weeks. To benefit from that, it allows you to swing with the punches a bit more. You're not putting yourself as an overly exposed amount of risk, because you're allowing for a greater degree of movement. And we'll talk about what stop losses are and things like that, and how to benefit from that in a minute. But basically, with the short-term trading, is we're looking to capture parts of trends or movements within a main trend. For instance, a trend is basically a point where it's increasing over a degree of time, a long degree of time, in an upwards or downwards fashion, a bullish or a bearish or a long or short fashion. Now when you're a short-term trader, you're looking to sort of take advantage of the peaks and troughs within the market and get in and out relatively quickly within a few days. Rarely a few days, it's usually a bit longer than that. And this allows you to benefit from the longer, slightly slower, but more proven trending market that's there. There still is risk, of course, and you still have to analyze quite a bit to understand where those peaks and troughs are and how to benefit from going long and short and where the best points of doing that are. The next point, and well, actually short-term trading you can use on spread betting, forex too. Sort of things like e-minis or sort of futures and options tend to be less, certainly in terms of an in and out trade would be less likely over more than anything more than a week. And then we move to long-term trading. Now long-term trading is where we take, quite obviously, the long-term view, and that's where you would say fundamental analysis comes in as opposed to technical analysis. And I'll briefly cover what the differences are. Technical analysis is where we look at the technicals of a chart, the actual price movement. That's all we're interested in. We're not interested in accounting or how much widgets they've made, how much profit they're making in terms of widgets. We're just looking at the simple, pure value of the stock right now and how it has been over a period of time. That is technical analysis. We use the chart to analyze where possible movements in the future will be. Fundamental analysis is very different. It ignores the actual current price. It uses projections based on how the company has performed, the company reports, what the directors are saying almost, whether they're employing more, whether the market for that particular product is growing or declining. And it all makes an awful lot of sense. But it also doesn't actually represent, well, it basically, they were able to represent the current value if the company was sold, but it doesn't actually go on to show you why the current value of that company's stock is at that current point. That is not based on fundamental analysis. The current point of the company's valuation on a chart is basically what traders believe it to be worth based on fear and greed, and not based on fundamental analysis. However, fundamental analysis does have a place if you're looking at a very long term, because that's when those would kick in over years. However, on a short term, whether the company is making more widgets this year or planning on making more widgets this year or next year is not really going to affect overall how the chart is going to respond or how that stock is going to respond over the next few weeks. So there is a place for fundamental analysis, but it's a very long-term view. And that long-term view would be certainly much more taken in terms of, say, an actual stock purchase. And that's where the key differences are. When you make a trade in terms of spread betting or e-minis or anything like that, you're not actually buying the stock. You're just saying, well, I reckon it's going to go in this direction or that direction, but you don't actually own any part of the company that you're trading. Whereas if you're buying a share in a company and you're looking at the longer term view and you're using fundamental analysis to gauge what that longer term view is, then you're actually buying part of that company. And that trade has an intrinsic value based on the value of the stock in which you bought. So overall, there are different ways of trading short term. You've got day trading, intraday trading, short-term trading, a few weeks, no more than a month or so, and then long-term trading where we're talking months and years. And they all have a place in trading, and they would all have a place when you become more successful as a trader and you have more money and more resources available to you, where there are points where you would actually say, oh, I'd actually wouldn't mind buying some stock. So there are places and means for that. The obvious disadvantages with stock purchase, of course, is that if the stock goes down in value, there is no way you're going to make money from that. There is no way you can make money when a stock is going down in value and you own that stock. There is no way you can do that. You can only do that if you're taking a contrary view with a broker or as a trade, as a going long or short. You can only go long, you can only buy to profit with stocks in terms of actually buying the stock. So I hope this brief introduction of what spread betting is allows you to see, basically what it is to go long and short, what day trading, short-term trading and long-term trading is. The final thing we'll cover is how you would protect the actual trade that you're trading. And this is called a stop loss. Now a stop loss, as the name suggests, is to stop your loss. And it's basically a trigger point below the point that you open the trade where you say, I want to close the trade if it reaches this point. So say for instance, if we opened a trade going long at 5,600 here, but we put our stop say at 5,590, if the stock went down, or if this chart went down and hit 5,590, the trade would be closed and we would only lose 10 points. For the sake of argument. The good thing with stop losses is they work either side, whether you're going long or short. The other good thing with a stop loss is that you can change it. So when, say if we opened a trade at 5,600 and it was moving up nicely and went all the way up to 5,800, during up and along that path, we can move the stop loss, just below, depending on the broker of course, but they do allow you to move it, but the actual gap between the current price and where the stop is tends to vary per broker. But you are allowed to move the stop in line with your trading. So this allows you to actually what we call lock-in profit, whereas you're sort of guaranteed profit once you reach a certain point and you're moving your stop upwards to capture that. And that's a very key thing to do in any form of trading, is to adjust your stops. One key rule is you do not ever trade without a stop. The other key rule is once you're beginning to make some profit, you look to lock in as much profit as you possibly can as soon as possible, but not at the point where you're putting the actual trade at risk, and certainly not at the point if you believe that the trade is moving quite wildly. Again, these are things which are covered within the course itself. So that's basically what spread betting is, the principles of how it works, and how you can benefit as a trader in terms of day trading, short-term trading and long-term trading. Thank you.